Coming up on Market to Market, where it comes to food and fiber, the Secretary gives his outlook for America, and how soybeans may play a vital role in the race for heart-healthy cooking oil. Those stories and market analysis with Dan Huber next.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, February 23 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Delaney Howell. Americans looking for a new place to live spent a little more on gas to drop in for a peak. Sales of homes tracked by the National Association of Realtors fell 3.2% in January. The drop is being credited to the smallest supply of homes available in nearly 2 decades. Just driving to an open house cost a quarter more per gallon than a year ago. Interest rates for financing a loan neared 5%, the highest since 2014. Those interest rates are expected to rise over the next year as the Fed pushes the amount it charges banks a few ticks higher. The hikes will affect the bottom line for farmers and ranchers already facing lower returns. This week, USDA's annual Ag Outlook Forum touched on profit and loss in the coming year. Peter Tubbs reports.
A gloomy outlook for farm income was balanced with a promise of a stronger safety net and a pledge for more federal spending in rural America. Agriculture Secretary Sonny Perdue addressed the annual USDA Ag Outlook Forum this week and assured farmers that the USDA was working to keep their operations profitable by reducing regulation and increasing funding to the farm safety net. The secretary spoke of his attempts to bring the White House toward the USDA's position on immigrant labor.
The people who come to America to work on farms and ranches are not taking jobs from Americans. You know that, I know that. These are not the people who are committing crimes. They're not the ones putting a burden on our criminal justice system or our welfare system. They just want an economic opportunity for a good job to provide for their families.
Perdue praised the White House for its infrastructure spending plan, specifically the $50 billion targeted for rural America.
With increased broadband access, e-connectivity will do for America, has the potential to do for America what I think the rural electrification did in the 1930s.
In a separate event, Secretary Perdue expanded on questions about the proposed controversial box food distribution program the USDA wants to add to the SNAP Food Assistance Program.
We think the 50% of the food expenditure that supplemental nutrition provides probably is appropriate amount for staples, and then the people would have the other 50% on the card they could purchase at their will that way.
The forum also was an opportunity to discuss USDA's crop forecast for 2018. 90 million acres of corn and soybeans are expected to be planted in 2018, despite stocks of corn, soybeans, and wheat sitting at 8-year highs. The USDA sees rising global GDP pushing demand for exports up in the coming years. Record production of meat and dairy is also expected in the calendar year. Milk production is forecast to rise 1.5%, pushing the estimated price per hundredweight down 9% to $16.05. For Market to Market, I'm Peter Tubbs.
Your doctor has likely been one of a long line of people reminding you to exercise and eat healthy. The American Heart Association recommends, among many choices, limiting foods high in trans fat. A decision by the federal government to help the matter has sent several seed companies on the path to finding low trans fat solutions. Those in the hunt include DuPont Pioneer, which helps fund the production of Market to Market. Colleen Bradford Kranz has our cover story.
In 2015, the FDA declared that partially hydrogenated oils were no longer generally recognized as safe due to increased risk of heart disease. Food manufacturers were ordered to phase out the use of artificial trans fats by June of 2018. Seed breeders had already accelerated work on improving cooking oils, soy, sunflower, and canola among them, nearly 10 years earlier, when the federal government began requiring trans fats to be listed on food nutrition labels.
At the same time that the oil value was declining because of all of these issues, the meal value was increasing. And so overall the value of soybean has been at a pretty good level. So it's sort of a lost value that they didn't recognize that they got dinged.
Food use of soybean oil fell 20% between 2004, the year after the labeling rule was finalized, and 2011. However, soybean oil remains the most widely used cooking oil in the country. For decades, food processors used a variety of partially hydrogenated cooking oils in the creation of meals and snacks. The oils are modified with hydrogen gas to increase shelf life and allow for use at higher cooking temperatures. Millions have been invested in the hunt for new oilseed varieties, both naturally occurring and genetically engineered, that might display that elusive mix of high heat stability, long shelf life, neutral taste, and improved health benefits. Many of those researching soybeans, like USDA molecular biologist Kristen Ballou, focused in on a heart-healthy monounsaturated fat known as oleic acid.
So we go from about 20 or 30% oleic acid to about 80% oleic acid. So we've shifted almost all of the fatty acid into this heart-healthy monounsaturated fatty acids. It's quite similar to how olive oil's natural profile is.
Ballou worked with University of Missouri soybean scientists who found a naturally occurring mutation that may solve the equation. Others have pinpointed their own versions and have spent recent years improving yields. Schillinger Genetics, an Iowa-based company that focuses on non-genetically modified products, gained the right to sell the University of Missouri high oleic seed commercially under the label Emerge.
Well, I think it's a evolution of change that's going on all around us, and a lot of it starts at the consumer level.
Schillinger acknowledges that the entire marketplace needs to be nurtured, which will involve getting farmers, soybean crushers, and oil distillers on board.
That's the differentiating value is hard to come up with unless you got somebody with an inquisitive mind on the other side in the laboratories looking at oil quality from the standpoint of shelf life or use in cooking French fries or things like that.
As scientists at the University of Missouri were at work, private groups were pursuing the same goal. DuPont Pioneer developed and began marketing the Plenish brand of high oleic soybeans, while Monsanto created Vistiv Gold. The industry is faced with convincing farmers to plant new seeds that must be kept separate from their conventional counterparts. For now, seed companies are paying premiums.
The grain prices were very high. Now they're coming down, and so it's a little different story.
So far, the nation's farmers are growing less than 1 million acres of the new soybeans. The United Soybean Board, which has invested $60 million in high oleic research since 2012, has a goal of seeing 18 million acres planted by 2023. DuPont Pioneer, which began large-scale production in Ohio and Indiana 6 years ago, has been recruiting elevators and soybean crushing facilities farther west. AGP's crushing plant in Hastings, Nebraska, stepped forward to take Plenish soybeans for the 2016 and 2017 growing seasons.
For us, it's just getting the product out on the volume of acres that an end user like AGP needs. Once that happens and they can go out and sell the oil. They lowered the premium this year, but the guys that were around the crush plant already delivering found that the 20-cent premium was well worth it.
The Ablett family of Inwood, Nebraska, located just a half-dozen miles from the plant, was among those who continued growing Plenish in 2017, even after the initial year's 40-cent premium was cut in half. The low transportation costs were key in their decision-making process.
Obviously, with new programs, new products, there's always some skepticism, but you know, there was some premium involved. The logistics of it made it somewhat attractive. You have to take a little more care than you would with normal commodity beans as far as cross-contamination, but really not a big deal.
The road to widespread acceptance still has a few bumps. AGP Hastings has changed course, and it will no longer accept the beans in 2018 because of the struggle to market the still unfamiliar oil. Ballew acknowledges there is more to be done as the federal deadline looms.
The pull is not coming from the farmers because they're an intermediate player in the health of consumers. The solution to the trans fat problem could be high oleic soybean oil. That's a solution that would benefit probably all Americans, but those Americans shouldn't have to pay more for that benefit. And so then we have to work backwards of if no one will pay more for a health benefit, how do we pull it through the marketplace? How do we make sure that each player feels rewarded for their part in the chain? And I think an economist is better suited to answer that than a molecular biologist.
For Market to Market, I'm Colleen Bradford Krantz.
Next, the Market to Market report.
Mixed export numbers and hot weather in South America had more to do with moving the commodity markets than figures from the Ag Forum Outlook. For the holiday shortened week, May wheat gained 7 cents, while the nearby corn contract moved 7 cents higher. Parched conditions in Argentina helped send the May soybean contract 26 cents higher, despite being overbought. May meal led the way again in the soy complex, climbing $5 per ton. May cotton expanded $4.18 per hundredweight. Over in the dairy parlor, April Class 3 milk futures lost 26 cents. The livestock sector was mixed as the April live cattle contract lost $2.80. Nearby feeders shed $1.23. However, the April lean hog contract finished in positive territory, gaining $3.20. The U.S. dollar index bumped up 80 points. April crude oil stayed above $60, pouring on $2 per barrel. COMEX gold dropped $25.90 per ounce, and the Goldman Sachs Commodity Index gained nearly 9 points to close at 452.20. Here now to lend us his insight on these and other trends is one of our regular market analysts, Dan Huber. In case you want to go over things again, you can download or listen to our market analysis and Market Plus podcasts online anytime at iptv.org/MTOM. Dan Huber, welcome back.
Thank you very much. It's great to be here, particularly for your inaugural show.
Well, thank you. I'm very excited.
Kind of exciting. So,
it is. Dan, let's talk a little bit about inflation here before we talk commodities, because I saw earlier in the week your newsletter, you focused pretty in depth on inflation rates.
Certainly.
We've heard a lot of chatter on Wall Street about an increase in inflation. Are we going to start seeing some of this concern pull monies into commodities?
You know, the inflation does tend to help bring a little bit of money back into the commodity market. You know, the last month I think we had a raw inflation rate of about 2.1%, which was a little stronger than a lot of people anticipated. And you know, on a year-over-year month change, it was at the highest in over a decade, you know. So I think it gave the idea that certainly we've got the economy maybe starting to steam up just a little bit. Of course, the immediate concern was that, well, that just means that the Fed's probably going to become a little more aggressive on boosting interest rates. You know, I don't think it really probably changed their plans all that much. You know, and actually, when you look at the numbers in the month of January, a lot of that came from energy spiking, from the cold weather, which is pretty seasonal. So yeah, I mean, 1 month it was exciting to see, and maybe I mean, for 2 years now we've been talking about when's inflation going to come back, and with so many people working, that usually puts inflationary pressure on just buying goods. As more people have more money, they're going to spend a little bit more money. Hasn't really happened to this point in time, so I think it's probably best to wait and see what February says. I mean, if we don't see a replay, that talk will cool off pretty rapidly.
Okay. Well, let's get into the commodities now. Let's start with wheat here. We've had a little bit of drought relief over in the plains. Will that be enough to turn conditions around?
Oh, well, we of course have a long ways to go there. You know, and really when you look at not just the plain states, I mean, really North America as a whole, we really sit in a rather critical situation for the overall dryness. You know, we're probably getting beyond the cold weather scares. You know, it's the wheat market's done nicely. We've had a nice little rally over the last month, but that said, you know, we've kind of pushed up into some old resistance zones. We're probably going to have something a little more concrete as far as weather issues there to really get this market to move much higher. So, you know, right now I think the assumption is going to be we're going to see a little additional spring wheat get into the ground. You know, if that turns out to be the case, there's some pretty strong headwinds to keep it from moving any higher at this point in time, at least. So
with that being said, have we put in a high yet for wheat?
Well, I think a temporary high, let's put it that way. You know, I tend to be a little more positive on commodities in general as we move out into the summer of 2018. But, you know, this is the time of the year, and absolutely, the South American situation has given all these markets a bit of a boost, particularly the soybean market. But, you know, you can only kill a crop so many times as well, and we're getting to the tail end of the weather issues there. So without really getting us out into our key weather time periods, you know, it's hard to feed a lot more bullish news in there at this point in time.
It is. Let's talk Latin American weather in soybeans.
Certainly.
What are you thinking there? What are your thoughts?
You know, it has absolutely been the driving force that have taken the soybean market, and the meal market, you know, really kind of led the pack up on that. And, you know, I think we tend to think of South America just in the term of beans, but Argentina especially processes the majority of their beans for export. I think they supply something like 46% of the meal trade that's going on around the world. So, I mean, that certainly helped lift that meal you know, well off the lows that we've been stuck at for months and months. You know, that said, I think we've almost reached a point that, yes, we continue to focus on Argentina, but when you go just a little bit further north, conditions have really been quite ideal in Brazil for the finishing out the bean crop. So it almost seems like every time we lose a ton of production in Argentina, we gain a ton in Brazil. So I think here again too, it's been great. It's really lifted the bean market up well over $1 now from the January lows. But you know, we've kind of reached that point in time where it's going to be a little tough to stretch it out much further than this, I believe.
Okay. So. Well, as you said, we've had a nice little rally here in the bean markets, and that leads me to a social media question we have. So. Randall in Galatia, Illinois would like to know how much life is there left in the bean rally and how come beans haven't dragged corn up with it?
Well, and to a certain extent they have. Corn's not quite 10% off of its lows, 7 or 8%, somewhere in that neck of the woods. If you look at the last, and realistically, if you look at the last 3.5 years in the soybean market, every time we would take the nearby bean futures somewhere between 1060 and 1080, it's just been a brick wall. And well, we've now returned to that 1060 to 1080 area. So, you know, without something out of left field, you know, kind of surprising everybody, I think it's going to be difficult to carry much higher than they are right at this point in time, at least until we get out into the summer conditions here. Okay.
So. Dan, let's talk corn. Sure. As you mentioned, we put in a resistance wall here. Can December corn get past $4?
You know, $4 is kind of that same range that we tend to find. You know, beans, like I say, we get 1050, 1060 to 1090. Corn starting at $4, and yes, that extends up to as high as $4.50, but really $4 to $4.20. Boy, it's just a very difficult area to go through. Yeah, but one of the great things about seeing the rally we have in the last 30 days is this took us right through the insurance pricing period. Yes. So we really gave a nice little elevation boost in price. From what I can gather, the volatility is going to be less than a year ago, so premiums should be down on crop insurance. So you know, it's really given the farm community a nice little opportunity to lock in some decent foundations, at least as strong as a year ago. But that said, boy, to get us above this $4 area, you know, to any significant amount, I mean, and I'm saying within 5 or 10 cents, yes, I think we've got to get out into an actual weather problem, so now you're really saying May, June before that can realistically happen. So.
Well, another big story when we look at the corn markets has been Latin American weather, as you mentioned. How do you think that will affect the corn market? You know, honestly, I think if there's been any story that's been underplayed at this point in time, it is the situation in South American corn production. And not per se because of the, yes, we know there's a drop in Argentina. Some of the latest
projections I've seen have taken them under 50 million metric tons. But more critically is what's happened in Brazil. And here the weather has actually been quite good, but the late planting really pushed back the potential of the second crop, and there's 70% of the production of corn in Brazil. So when you look at the total South American production, we're going to be probably easily 10% less than a year ago, and I don't think people have really kind of come to grips with that. And part of that's the psychology in the corn market right now. I think they look at North America and think, corn is just bulletproof. We can throw whatever weather we want at it, and it's really not going to phase it. So that could lead to some interesting surprises later this year. So.
All right, so something to watch and see.
Yes, absolutely.
Let's talk livestock, Dan. April live cattle, we've rallied to 128 earlier in the week. We've had a little bit of a pullback through the rest of the week. Do you think we'll be able to get back above those levels?
I tend to be a little bit friendly on the livestock market in general, particularly in the cattle right now. I think with the economy continuing to kind of chug along a little bit and showing improvements there, I think that is price positive or positive for the consumption side of the beef market. So, the big caveat, be it cattle or hogs, either one, is what we're going to look at as far as the export scene. Yes, the dollar has broken down pretty severely here in the last year, but it recently has stabilized a bit and is starting to look like it's going to show a little bit of a rally, so that could throw some headwinds into that export scene. So,
are you still bullish when we look at cattle? We look at export sales numbers. They were down 10% from the previous week and 55% on a 4-week average. Are you still optimistic?
Well, and again, like I say, I think we're running into some headwinds here right now with the dollar change. And, I still think we're not seeing any favors done to the ag community by all the rumblings we continue to have with, is NAFTA going to become a viable product or not? That might even impact the hog market just a little bit more than when it comes to NAFTA than the cattle. But same token, the tone between China and the United States right now is not conducive to good relationships. When we're basically throwing out what seemed to be the beginning salvos of a trade war, that is not a good situation, because China realistically was just kind of opening the doors to our cattle again, and that could slam those doors shut in a hurry.
It definitely could. Yeah. Let's finish up the conversation today with hogs. Sure. We've seen a big slide since the beginning of the year. Do you think we've put in a bottom for now?
I think the breakdown has been enough that we should be able to bounce them back up. Here again, too. I think if we saw something positive come out of discussions with Mexico, I think that could really help buoy that hog market back up. We know the numbers are on the increase. 2 to 3% higher hogs once again. Interestingly enough, when you look at where we were about 3 weeks ago in the hog market, that is, if you look at any one of the individual contracts, that is the same level the hogs have peaked at every year for the last 3 years. So it is, not unlike the $4 corn or the $10.50 beans. It's an area that has just consistently stopped this market. So we're going to have to throw some kind of new demand, or I guess we're getting past the point of the year. You're going to look at some real health issues in the swine herd. But yeah, demand's going to be the name of the game if we can push that higher from here.
Well, and speaking of demand, export sales were up 90% from the previous week, 68% up for the 4-week average.
Right.
Optimistic there?
A good sign, a good turnaround. Of course, I think the correction in the hog market probably helped to really stimulate that again. So it's, but we need to keep stringing those together here to make that at least take us back to the levels that we were at previously a few weeks ago.
Is overproduction a big concern for you when you look at hogs?
Not yet. But again, like I say, I think the export side is probably going to be our salvation there. Domestically, are we going to see consumption pop up a lot? Probably not leaps and bounds, but here again too, if just looking at a general sense, when the economy seems to be moving in the right direction, we tend to see meat consumption push a little higher period. And of course, we're soon entering the barbecue season, which never hurts either. So it's again, as long as the economy's kind of chipping along, I guess I keep a somewhat positive attitude, at least into the summer months. So
one quick final question for you as we wrap up here. Speaking of the summer season and barbecue is right around the corner, are we going to prepare here soon for a summer rally, or are we in the process now?
Yeah, speaking of livestock?
COGS specifically, yeah.
You know, and I think that's probably what we're getting set up to do right at this point in time. Again, you know, that may just take us back to where we were a month ago, but that would be a welcome push here at this point in time.
It definitely would. Definitely would. Dan Huber, thank you so much for being here.
My pleasure. Thank you.
That wraps up the broadcast portion of Market to Market. You can catch more market discussions in Market Plus, available in podcast and video form on our website. Like us on Facebook. As algorithms change, the more you like, the more you see. Join us again next week when we'll examine how one community was able to harvest dividends after a devastating tornado. So until then, thanks for watching. I'm Delaney Howell. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.